Welcome to Building Your Real Estate Portfolio, a guide for rookie investors. Whether you're just starting out or looking to expand your knowledge, this guide is designed to help you navigate the world of real estate investing with confidence. Step 1. Define your investment goals. For your short-term goals over the next 1 to 5 years, aim to acquire 1 to 3 properties for cash flow or appreciation. During this period, it's essential to learn the basics of property management and real estate financing. Looking further ahead, your long-term goals, spanning 10 to 20 years, should include owning a portfolio of income-producing properties. The ultimate aim is to generate enough passive income to replace your active income and establish a plan for transferring wealth to the next generation. Step 2. Assess your financial position. Start by checking your credit score. Aim for a score of 620 or higher for FHA loans or 700 plus for conventional loans. Next, calculate your budget. Make sure you have savings for down payments, or look for low or no money down options. It's also crucial to have emergency reserves for repairs and vacancies, ideally at least 3 to 6 months of expenses. Finally, ensure your debt-to-income ratio, or DTI, is below 43% to qualify for financing. Step 3. Educate yourself. There are several key books you should consider reading, including Rich Dad Poor Dad by Robert Kiyosaki, The Millionaire Real Estate Investor by Gary Keller, and Buy, Rehab, Rent, Refinance, Repeat, also known as BRRR, by David Green. Additionally, join platforms like BiggerPockets to learn from experienced investors, attend local real estate investment groups or meetups, and take online courses on property analysis and financing. By continuously educating yourself, you'll be better prepared to make informed investment decisions. Step 4. Start small with your first property. House hacking. Purchase a duplex, triplex, or quadplex using an FHA loan, which requires only 3.5% down. For example, buy a duplex in Newark, New Jersey for $400,000. The down payment would be $14,000 with an FHA loan. Live in one unit and rent the other for $1,800 per month. Use the rental income to cover most of your mortgage. Why house hacking? Minimal upfront cost. You learn property management while reducing your own housing expenses. Plus, it builds equity for future investments. Step 5. Analyze deals before buying. Use these tools to ensure a property meets your financial goals. Deal Check or BiggerPockets calculators to analyze ROI, cash flow, and cap rate. The rule of 1%. Monthly rent should be at least 1% of the purchase price. For example, $2,000 rent for a $200,000 property. Cash on cash return. Aim for a return of 8 to 12% annually. Here's an example. Calculation. Purchase price $300,000. Monthly rent $2,500. Expenses, including mortgage, taxes, and insurance, are $2,000. This results in a cash flow of $500 per month, or $6,000 per year. Step 6. Leverage creative financing. If you lack significant savings, explore these options. FHA loans, which are great for house hacking due to their low down payment. Seller financing. Negotiate directly with the seller to avoid traditional financing. Partnerships. Partner with someone who has capital while you handle the legwork. And the BRRR strategy. Buy a distressed property, rehab it, rent it out, refinance to pull out equity, and repeat. Step 7. Scale your portfolio. Refinance and reinvest. Use equity from your first property to fund your second and third investments. For example, refinance your duplex in 3 years, pull out $50,000 in equity, and use it to buy a fourplex. Diversify property types, add single-family rentals, add multifamily properties, eventually, commercial real estate, focus on cash flow. Ensure each property generates positive cash flow to sustain the portfolio during downturns. Step 8. Optimize for tax benefits. Depreciation. Reduce taxable income by depreciating property value over 27.5 years. 1031. Exchange. Defer taxes when selling a property by reinvesting profits into another property. Cost segregation. Accelerate depreciation for certain property features like HVAC systems and appliances. Step 9. Build a team. A strong team ensures smooth operations and reduces your workload. A realtor helps find and negotiate deals. A lender advises on financing options such as FHA, conventional and hard money loans. A contractor handles renovations and repairs. A property manager manages tenants and maintenance as your portfolio grows. Finally, a real estate attorney handles contracts, zoning issues, and legal protections. Step 10. Plan for generational wealth transfer. Set up a living trust or LLC to protect your assets and simplify the transfer to heirs. Educate your heirs by teaching your family how to manage and grow the real estate portfolio. Reinvest profits by using rental income to buy additional properties and expand the portfolio. Real-world example for you to follow. Investor profile name, Maria Lopez. Location, Paterson, New Jersey. Starting capital, $10,000 in savings. In year 1, Maria started with house hacking. She bought a triplex for $300,000 with an FHA loan. The down payment was $10,500 and she borrowed $5,000 from family as a gift. Her monthly mortgage after tenant rents was $500 out of pocket. She learned property management and reinvested her savings. By year 3, the property value increased to $350,000. Maria refinanced and pulled out $40,000 in equity. She used this to buy a fourplex in Trenton for $500,000 with a hard money loan, then renovated the property for $30,000 and refinanced it into a conventional loan. By year 6, Maria expanded her portfolio. Now owning 7 units, she saved rental profits and used a 1031 exchange to buy a 10-unit apartment building in Newark. The rental income from the building was $10,000 per month, with $3,000 per month in cash flow. By year 10, Maria diversified into commercial real estate by purchasing a mixed-use building in Princeton, generating $15,000 per month in income. Her total portfolio value is now $5 million, with an annual passive income of $150,000. Final advice for you. Start small by using house hacking or FHA loans to reduce upfront costs. Think long-term and focus on properties with appreciation and cash flow potential. Leverage equity by refinancing and reinvesting profits to scale quickly. Build a team of realtors, contractors, and attorneys to simplify your journey. Finally, educate yourself by reading, networking, and learning to minimize mistakes.